Good afternoon, everyone. All right, so we're going to take a tour of the world of how money is changing underneath us. Now, I am a professional futurist. I have a podcast called The Next Billion Seconds. Have a listen to it. I have to say, as a futurist, I get to survey a lot of the future. This is the topic that gets me out of bed in the morning. Of all of the topics about the future, this one is the big one. This one is going to touch every life in every way. So let's get started. This story begins in a very weird way. It begins on the 31st of October in 2008 when someone whom we do not know, we only know him by a pseudonym, Satoshi Nakamoto, drops a paper on the internet, which happens all the time, and yet this paper changed the world, and we don't know who wrote this paper. Still, 12 years later, 13 years later, we have no idea. What this paper described was a new way to work with data. He described a way to give data some qualities that data had always wanted but had never had before. So let's take a look at what those qualities are. So here's your normal data. There it is just sitting around. He said, okay, we can wrap the data up. Now, data gets wrapped all the time. If you send data across the internet, it gets wrapped up and then unwrapped when it arrives. This wrapper was a little different. He said, we're going to put a wrapper around it, and when we put this wrapper around it, you will be able to authenticate the data. You will know that this is the data that you're looking for. And not only that, you'll be able to peek in and you will be able to audit the data. So you'll know how much data there is, what numbers are in there, so you'll be able to be quite explicit. And because of that, you will be able to know that this is the original of the data and not a copy of that data. Now that's very important because data is really easy to copy. So how do you know when you have the original instance of data? Well, this technique described in this paper said that's how you do it. Now let's take a look at actually how that works in practice, because what they described in practice is something that's a little unusual. So we're going to step through it. It's essentially a form of truth by consensus. The data gets to ask other data whether it's the real deal. So in this case, our little data, it's going to go and ask this other data block, hey, am I the real deal? Data block says, yes, absolutely you are. Ask this data block, am I the real deal? This data block says, yes, you are. This data block, am I the real deal? No, mate, you're not the real deal. But it's by consensus. And so 2 out of 3 say it's the real deal. That is the real deal. So this one, someone's talking about a blockchain. It's not just data sitting on a hard drive. It's a process of consensus that data actually checks in on one another to find out which one is real. Is it the real deal? All right. The paper then went on to say, okay, now that we've added these qualities to data, what we're going to do is we're going to describe a digital currency using these qualities. And it's really important because when you have a currency, you have to be able to authenticate that this is currency. You have to be able to audit it so you know how much currency you have. And very importantly, you can't just copy digital currency. You can't counterfeit it. If you could just copy it, your currency would be worthless. So it created a currency with those qualities of data. That currency is Bitcoin. We all know about Bitcoin. And of course, Bitcoin began from its very simple beginnings in 2009 to arrive at a point where the aggregate value of all of the Bitcoin in the world now is greater than the GDP of Australia. That really says nothing about the actual value of Bitcoin. It says something about the strength of the idea of the blockchain that underpins Bitcoin. All right. It wasn't very long before people said, okay, we can do this with a digital currency. What are other sorts of things that we can wrap up with this amazing new technique? And around the middle of the last decade, people said, wait, maybe we can wrap up a computer program. Computer programs are just little bits of data. So they did that. And when they did that, they found that they gave a computer program 3 qualities that computer programs always wanted to have. You can authenticate that this is the computer program that you're supposed to be using. You can audit the computer program line by line to inspect it, make sure it's actually doing what it says it's doing. And you can copy protect it, which has been a big problem in the field of software because you can know that this is the authentic original copy that has been sold. All right. Once you give those qualities to a computer program, it can now act as a peer and operate on the digital currencies there as well. So this becomes what we call a smart contract. So it is a computer program that's been wrapped up, that's operating on digital currency that's been wrapped up. And in this very simple example, this very simple program operates on a digital currency and just basically divides it into two piles, one of the simplest operations that you can imagine. We call these computer programs smart contracts when they're operating on digital currencies. All right, so you have digital currencies all wrapped up, you have programs all wrapped up, and people said, maybe we can wrap lots of other things. And fairly soon, people started to say, well, let's wrap up music, MP3s that are online, or we can wrap up images, or we can even wrap up house deeds. And when we do that, we can authenticate that this is a Taylor Swift song, we can audit the fact that this is an actual property deed, and we can determine that this is an original Da Vinci. So these things now become what we call non-fungible tokens. So that's how we got basically from 2008 to where we are right now. And we will come back to non-fungible tokens in just a minute. But right now, the entire world, as you saw from that cover in The Economist magazine, is going mad for digital currencies. And here's a little map that shows you basically many countries around the world are currently working on digital currencies. And you see Australia's on the map too, because we are working on a digital currency. Let's take a look at why that's actually happening. And let's actually take a moment to think about what a digital currency actually is. Because most of the time, most of us in Australia feel like we're already using a digital currency because probably all of you paid for your coffee this morning by doing a tap and go, right? You just touched your smartphone to the FPOS terminal and it all happened magically. And you go, well, that's digital currency, isn't it? That's a digital payment. But that digital payment, to make that happen, takes an enormous amount of work. So this is what we would call classical payments with classical currency. It's a transfer between two bank accounts. It requires multiple authorizations with the credit card provider and then the bank and then all the way back. It's delayed settlement. Credit card transactions can settle hours or days later. It is expensive to maintain. The big four banks spend tens of millions of dollars every year maintaining infrastructure that has to be up 24/7. And as we found out during the bushfires and in the floods, it lacks resilience to failure. If your Wi-Fi goes out, if your mobile broadband goes out, if your electricity goes out, all of these things can affect the ability to be able to use digital payments. Now, the difference here is when you actually go to digital currencies, what we would call now post-classical currencies, you get to an entirely different way of thinking about it. In that case, the cash, the digital cash, is actually stored in a wallet, which is a software program, on someone's smartphone or similar device. And then when they tap that onto an FPOS terminal, what happens is a direct transfer of value, just as if you were handing over dollar bills at the till. So there are no authorizations required. It settles immediately, and it requires no infrastructure. Now, that is not such a big issue here in Australia, which is why we think we already have digital currency. But let me tell you, there are 3 billion people in the world who are either unbanked or underbanked who all have smartphones, but don't have access to a banking system that gives them fancy credit cards and FPOS terminals everywhere. So most of these people are functionally shut out of using smartphones as part of the money economy. So what they need is a type of money that is purely digital so that it will work well in their smartphones. This has been the case for years now, and it has been a growing problem. So in 2019, a little company you won't have heard of called Facebook decided that they were going to try to solve this program with a cryptocurrency that they called Libra. They've recently renamed it to DM. The basic idea here is that they were going to create a global private currency so that people would be able to exchange value using their smartphones, using the Facebook apps, using Facebook Marketplace. So it would become a global medium of interchange for people to be able to trade. Now, when that happened, pretty much every central banker in the world's heart skipped a few beats. And it wasn't very long until Mark Zuckerberg was being called in front of Congress, being faced with images like this Zuckbuck, because everyone wants to make sure that Mark Zuckerberg does not get his hands on the global supply of currency. So basically, central bankers have done everything they can to slow the acceptance of DM. It is gradually rolling out. We'll see some of it this year, starting in Switzerland, which is where the project is based, but it is slowly running out. But there are a number of other projects that are coming to fruition or have already come to fruition. The most important of these is the ECNY, the digital yuan. This is being rolled out by the People's Bank of China. It is already being used. It's been tested in around 20 cities around China already. It will be rolled out full scale in time for the Winter Olympics in February of 2022. And the People's Bank of China has made it completely clear that they want to replace all paper notes in circulation by the end of this decade using the digital yuan. And it looks as though they also want nations that are participating in the Belt and Road Initiative to use the digital yuan as the settlement currency. This has a lot of people very concerned because this effectively routes around SWIFT. It routes around all of the normal indicators that prevent money laundering, and it gives China an interesting in to the international financial system, which is currently managed by the United States and the Western powers. So there are geopolitical implications around the introduction of the digital yuan. All right. Coming alongside much more slowly are a lot of the other central banks. So we know that in November, the Reserve Bank announced a pilot project between the big four banks to be able to do a loan settlement system using a tokenized Australian dollar, digital Australian dollar. That is just basically in testing phases. We know that the European Central Bank has announced a 4-year project to get a digital euro out there. The Bank of England announced a Bitcoin a few weeks ago. They haven't done anything about it yet, and we know that the Federal Reserve is also looking at this. These projects have been years in the making. They're still years away, and the longer that they wait, the greater the opening they create for these privatized digital currencies. So let's take a look at some of those. Of course, Bitcoin is the one that everybody's already heard about because that is a privatized digital currency. Unfortunately, the cost of transactions in Bitcoin is now $60 or $70 because the price of Bitcoin is so high. So it is no longer useful for its original design, which was as a payment mechanism. Ethereum is a coin that's used to create smart contracts. It has also become very expensive, and so now the cost of using it to do transactions, again, is too high for it to be used effectively. You have Facebook coming along with DM, but there's a lot of other contenders. I don't know if any of you use the Signal app, which is a private messaging app that's very secure. They've just signed a deal with a new cryptocurrency called MobileCoin so that people will be able to transfer that inside the Signal app. So it's very possible that as long as we don't have a state-based digital currency, there's a wider opening for a privatized digital currency to come in and dominate because there's still that demand from billions of people around the world to be able to trade on the smartphone, to be able to carry currency with them and get the benefits of that currency. And here's the important thing. When you get digital currency on a smartphone, that also means that you can have smart contracts operating on that digital currency on the smartphone. And so as soon as you have digital currency on a smartphone with a smart contract doing things with that currency, you have turned your smartphone from a wallet into a bank, because these apps will become very sophisticated and people will now be using and downloading and trading and sharing the best smart contracts for their smartphones to do the most with their money. These are functions that were normally happening with investment firms and in banks. They will now be happening in smartphones and with smart contracts. All right. Let's take a look at how this transition is going to happen over about the next 5 or 6 years. We're going to get to the point where there's a good enough digital currency. Right now, there are several contenders. About $150 billion has been sucked into this virtuous cycle already. So it's not just the trillions that are in Bitcoin or in Ethereum, but you're really talking about money that's being used for payments and for banking. So it's about $150 billion already there. And what happens is, as more money gets sucked in from the classical system to the post-classical system, people find more things to do with it. They use it to make loans, they use it as collateral, they use it to invest, they use it to securitize things. This is a new field that's called Decentralized Finance, or DeFi. These are these smart contracts that are being created and then shared broadly in order for people to do the most with their digital money from moment to moment. And of course, if you see your mate next to you who's making money using these tools, using digital currency and using decentralized finance, you're going to have a penny drop moment and you're going to start to use those tools as well. And that will lead to increased usage, which will pull more money into the digital currency system. And you get this virtuous cycle that will pull more and more money over the next 5 to 6 years out of the classical financial system and into the decentralized and digital currency system. All right, so that brings us to probably around 2023, 2024, 2025, and with luck, we will have a really good digital currency from either the Reserve Bank of Australia or from the United States or from the EU that we will be able to use in all of these transactions, and not just a privatized currency, but we'll see. Now, where do we go from there? Well, you've probably been hearing about these things called non-fungible tokens. And there's some really nice examples of these that have come out. One of them was from the National Basketball Association in America. They basically created the digital equivalent of a trading card. They called it a Top Shot. They released limited numbers of these. And of course, because of the qualities of the wrapper, you can limit to, say, an edition of 10 or an edition of 100. You can sell them, and of course, you can trade them. And you can't just copy them willy-nilly because they don't allow that. The wrapper forbids that from being just copied. All right, so you have these Top Shots, and now there's actually a thriving trading economy that's happening with these digital playing cards. We will be seeing a lot more examples of this in very rapid order. Now, back in March, a columnist for the New York Times said, oh, wow, it's really all going off with these non-fungible tokens. I'm going to take my column, wrap it as a non-fungible token, I'm going to put it up for sale. He got $569,000 US for that, which he immediately donated to charity, but then muttered he didn't know what the tax implications of that were going to be. But just by taking a column, having a big enough podium to talk about it, he was able to sell that thing for $600,000. And then, of course, something that you probably all heard about was the sale at Sotheby's of a work called Everydays by an artist called Beeple, which went for $69.1 million US, almost 100 million Australian dollars. And this, again, was a work that was a collection of 5,000 other works that he'd been made, but he'd wrapped it up as a non-fungible token, so this is the original work. What is common to all of these is that there's a digital work that is not really valued and not really valuable that has been wrapped and therefore becomes authorized and auditable and unique, and because of that becomes an asset. And that is the process that we will start to see taking place over the next 5 years. Where we are going, every organization everywhere and every individual everywhere will take all of the data and wrap it up and turn that data into assets. That's actually going to be a good thing for businesses because it means you're going to be able to get insurance on data assets, which is really hard to do now. But once you've actually identified them as an asset class, you can actually be able to get insurance for them. But we're also going to be able to do this with all of the things in the world, because things in the world, like a property, can have a deed that refers to them. So we're also going to wrap up all of the things. As soon as we do that, as soon as we turn all of the data and all of the things into wrapped objects, putting them on the blockchain, we can now operate on them with smart contracts, which means that they can be bought and sold and securitized and collateralized and borrowed. And that leads to the world of now the late 2020s, which I call the financialization of everything. So pretty much everything in the world is going to become some form of financial and financially manipulable and tradable asset. And all of these assets will have smart contracts connected to them that will have been programmed by their owners, that is us, in order to maximize their value from moment to moment. So every one of these trillions of entities of financial value will be seeking alpha. And that is a very different universe than any that we have ever had to confront in the financial world. Because normally we're just used to human actors and maybe a few computers running around making trades. Well, all of these things are all going to be traded entities and tradable entities, and they're going to be doing both all of the time, seeking to gain value for us. And this is the point where, as a futurist, I have to go, I don't know what happens after this. That is a world that is right around the corner, and yet we don't really know what it's going to be like. But what I can tell you is the best way for us to think about that world is for us to start to change the way we think. because forever we have thought of code as being this one thing over here and value being another thing over there. And I can tell you that the way we need to change our thinking is that code and value are two sides of the same coin, that this is the core of the idea behind post-classical finance, that it's not just value waiting to be acted on, it's value that has code that makes it active itself. That money is thinking, that money is smart, that assets are always working in their own and your own benefit. And if we can get our minds around that, if we can work that into how we think and how we design our businesses, then we will thrive in the era of post-classical finance. Thank you very much.